So, good afternoon, everyone. Today, we are going to talk about the topic which is very close to the heart in terms of access to credit. We all talk about increasing the number of people in the financial inclusion space, and what do we need to do for that? And the access to credit is also something which is very broad and very unclear, because you will have to identify whom you need to give this access to credit, and for what amount, and what's the way in which you can collect it back. So that's also very critical. So with this, my first question starts with the government have really pushed hard and have simplified this aspect of giving information about users with public digital infrastructure which has been around, and with account aggregator coming in so that more amount of data comes in, and with again RBIH platform being introduced. So my question is to all the panelists today, where you can pick this up one by one, in terms to say that how do you feel that the financial institutions will be enabled to access credit and enable a lot of financial inclusion?
Okay, we're going in sequence, so I start. Okay. So, look, I think you covered 2 or 3 of the very important points, and I think I'll just touch upon what, from our perspective as a large bank, we see as the enablers. The digital public infrastructure is an enabler, I believe, not just for credit. It certainly is an enabler for credit, no doubt about that, but for financial products in general. And speaking for what we see in India, vis-a-vis what we see in the rest of the world, having seen some of the other economies as well, I have no doubt in saying that what we've created and what we are creating, there are launches, including very recently and some which are imminent, on how digital public infrastructure can be used for financial services and at scale. I think that second part is extremely important, because solutions for India will need to be built for India, will need to be ones which work in our unique ecosystem and which work at scale. So just a few of them to call out, which all of us are familiar with, are, and I'm not even getting into the account aggregator framework, which is still in the build-out. Ones which have really become part of the mainstream are KYC, DigiLocker. We've got public infrastructure which allows us to know everything about a customer, and we'll talk about how it enables credit as well, but in my view, it enables financial inclusion in general. Investments, SIPs, all those kind of things become much easier through the digital infrastructure. So you have the ability to identify a customer, you have the ability to collect a payment, the customer has the ability to make a payment, all of which ride on the rails of the DPI. So I think credit to the government and all of the people who've used it. They've actually taken that infrastructure and built very meaningful products on it. And that's where I think we've only just scratched the surface.
Absolutely. And in fact, I want to know from you, ma'am, forward-looking in terms of with RBIH and AA.
So, Arjun's covered it very effectively. DPI, or Digital Public Infrastructure, has made huge inroads in India, and you can, comparable to the best, or even better than the best in my view, from that standpoint. And financial products in general, as well as access to credit, has come a long way. Particularly for individuals, in my view. I think the advances that have been made on digital public infrastructure and access to credit for individuals has been huge. The forward-looking view, in my view, individuals is, I think, a done story. I mean, there can be some more examples, and I'm sure through the course of the session, we will get some more examples of what banks like us are doing for financial inclusion with dairy farmers in Gujarat and all that. Talk about that. Where I think the forward-looking view, which all of us need to spend time on and understand, is how does this become better for small and medium enterprises? India is a country of small and medium enterprises. India is a country where growth will come from small and medium enterprises. What more should we be doing to make sure access to credit to that community becomes easier? And that's where things like account aggregator, for example, will play a very significant role. Or for that matter, what ONDC is doing. If you look at what ONDC is doing, it's creating a history by which small borrowers, small SMEs can get onto the platform and start selling their products. So you automatically create a trail which enables banks like us to see what is the kind of turnover you're seeing through the account, therefore what is the likely cash flow, therefore what is the kind of working capital cycle and the working capital requirements, and we can start lending to them. So between account aggregator, ONDC, and areas like that which are gaining the SME growth engine becomes much stronger. So that's where the future lies, in my view. Individuals, we can all innovate, and we're all doing a lot of it. I'm sure Anurag will talk about what he's doing on credit cards. Arjun will talk about what we're doing with some of the other where is the rubber hits the road is really on the SME side, in my view, and that's where a lot more innovation needs to come in, and the future will lie in that one, in my view.
Absolutely, bang on. So my next question comes in the same way, where as lenders can it says that lenders can decide in terms of whom they need to give credit. It also improves in terms of the social impact that it brings to you. Say that you're doing good and without minimum risk. I know it's a lender's paradise if that situation comes in, but with that in mind, in terms of how do you define risk segmentation then for the consumers that comes in terms to say that whom do I need to give credit and what definition do I need to give credit to them and for what period? So how do you define that in this paradigm when you have people coming in through the door?
That's a very brutal question because there's no one answer for the segment you're catering to. I'll talk from the perspective of the segment we largely work with, which is the mass market, lower mass market, not who you would call the prime. And to a large extent, just building on what Shalini said, a large part of our segment is actually self-employed and small business owners. See, in that context, what the DPI is essentially doing is removing information asymmetry in the market. No longer is your business model differentiator proprietary access to information, right? That's something that may have worked in other markets but cannot work in India. So the onus is on us to then make sense of that information and really think from a credit underwriting perspective, what does that data tell me? Being a digital-only, digital-first company that does not typically look at a customer or physically meet a customer, I think the essence is, number one, from a credit standpoint, establishing what is the steadiness of income and repayment capacity. And of course, the second aspect being the fraud aspect, right? I mean, it's a cliched thing within the lending fintech domain, but fraud underwriting is as important as credit underwriting for people like us. So when we think about underwriting this segment, every piece of information we get, for example, the account aggregator has been really a boon for us. Suddenly looking at daily transaction flow is giving me meaningful information about a customer which I did not have before. Yes, now I can therefore be far more certain about his income capability, about his debt burden, and therefore make a very judicious sense on credit and be very precise. Where otherwise I would do a very, very big haircut in terms of how much limit I want to extend because there's an uncertainty in what I'm deciphering. Now I'm getting more precision behind it. At the same time, that same digital infrastructure is giving me more data points to assess the intent to repay. So with every layer of data being added, and I'm looking forward to GST information being available as a ready-to-use public infrastructure, my ability to understand a customer and mitigate my fraud risk is just improving. And needless to say, the models will keep evolving with every additional piece of data, but fundamentally that's the approach.
Thanks. Just coming back to Arjun, where you left, in terms of saying that, the kind of consumers that you're going to bring in, how do you feel that analytics is going to play a role in terms of, segmenting these users and then, identifying the right credit-worthy consumers?
Oh, absolutely. I think it's going to play a pivotal role, in fact. So both Shalini and Krishnan talked about how, one, for the particular segment, and two, in terms of how it could be used for the mass market. I think it's really, if you look at the role of analytics, it's across the entire life cycle. And just to simplify it or to give it sort of a bit of a mnemonic, just look at it as ABC. A, assessment. B, build out. C, collections. And on every one of these stages of the credit life cycle, you'll find that analytics plays a large role, and it's inextricably tied into the digital public infrastructure because, as you rightly said, it's that infrastructure which provides us the data. So let's look at assessment. Who should be given what form of credit? Because there are different forms of credit today. We will have very soon UPI as a way to access credit itself, and that itself is now a card can be offered on UPI, you can have a credit line on UPI, and now you can have a pre-sanctioned credit line on UPI after yesterday. So that's the form of credit. When you talk about assessment, what form of credit and to whom? So the assessment in terms of repayment capability becomes so much better, infinitely better, and that actually helps because then you can figure out who are the right guys to give the credit to, and you don't have to set these blanket caps, which then sort of keep a large part of the community out of the pool of credit. Then look at the build out. Reaching out to customers at the right time is again something where analytics plays a role. When to reach out to a person, whether it's BNPL, whether it's at the point of purchase, or it's a particular need in their life, or you've seen something through the data and the analytics which tells you that this might be the opportune time to offer, let's say, a vehicle loan or things like that. That's the build out. And see, as you alluded to as well, I think in terms of collections, when to reach out to who are the self-curing customers out of a set that hasn't paid, that's again something that we can do analytically. So if you look at that entire ABC strategy, you can pinpoint much more effectively. Literally, you know, the cliche is N is equal to 1, hyper-personalization. You can do that with the power of analytics. You can also figure out and use that to time it right. Say when to reach out, whom to reach out, when to reach out, and how to, of course, collect better. And then they use the digital public infrastructure to pay us back, because it's almost ubiquitous. I can't figure out anyone paying anyone through checks anymore. It's all through the various forms of DPI. So analytics, I think, coupled with the DPI and the data which it creates, is the bedrock on which access to credit will be built in our country for the foreseeable future.
Sure. Thanks.
Couple of panelists waiting to speak, but if I can just add on this point on analytics with your permission. Two examples that thing. One is what we guys do with you in Experian, where we built obviously the entire scorecard and using bureau information plus our own captive information to arrive at a very effective scorecard. And the entire origination that Federal Bank does on credit cards and personal loans is completely digital. We don't even have a physical account opening form for both these products. We've gone completely digital on those two products. So that's an example of where analytics has played an important role, industry-wide analytics, which is done. The second is a more kind of, for lack of a better term, a more financial inclusion rural example. We do work with dairy farmers in Gujarat, where we started offering a digital bovine loan, cattle loan. For the unfamiliar, it's the digital cattle loan. And the data that is used to underwrite is actually the pouring history that the dairy farmer has with Amul extracted through an API. So through an API, we can get information as what has been the pouring history of the cow, and therefore, you know, what is the kind of turnover that is expected in the account, and therefore how much is the credit limit that the person could get, and therefore how many cows can he buy. You know, so it's literally all done analytically using data, and there's no physical underwriting at all. So these are just two examples of where analytics have played a predominant role in easing the A part of what Arjun mentioned. Yeah.
Actually, when we speak of analytics, it's usually most of the time we dwell upon acquiring new customers. In Karnataka Bank, we have around 13 million customers and a lot of single product customers. And many of these guys suffer from access to credit, and most of our analytics initiatives have been as to how we can make life simpler for them, offer them products which they otherwise have to go to another bank or scout around. So we've spent a year constructing those models where we are looking at propensity-based approaches for the agri and MSME segment.
Thanks, Sekhar. I think with that, as Arjun has mentioned about UPI on credit, I would like to know more from Anurag in terms of how do you feel that UPI on credit now, as RuPay is already there, and then now the credit lines have also been given. So you've been partnering a lot of banks in terms to fuel this journey. So how do you think it's going to be?
So UPI is like an infrastructure layer now. It's a massive adoption curve in the country. 500 million people using it. So it opens up massive opportunity for credit disbursement, and I can add actually on both the dimension of the risk business, which could be cost of risk can come down, and cost of operations. And cost of operation is extremely important point, because especially when we are talking about access to credit, just wanted to give a dimension to it, that access to credit can be defined in many forms. It could be, is the right amount of credit is being given, or probably less amount of credit is given at a, can it be given faster, and can it be given cheaper? All three dimensions are there, just not about credit risk itself. If you look at the bureau data, there are 500 million people have a bureau records, 800 million adult population. So there is a credit being underwritten. But when you look at the product penetration, product holdings, it's quite still low. So essentially, underserving itself is a very large problem to solve. And what we see is UPI, especially because UPI works for customers who already have a bank account. And thanks to PMJDY, the account penetration has gone up. We can study data, underwrite, distribute, and all that. So, especially coming to CC on UPI, or rather UPI, credit on UPI, where after yesterday we have to qualify because both the products are now there, not only credit card, but credit line is also there. Is that it just create lots of use cases which can feed into actual credit utilizations. And the moment you are able to track end users, especially when it comes to micro transactions, we are able to underwrite better on this. We have seen in credit card underwriting models where once the customer stays with the bank, after a year, behavioral scores typically predict better risk than even credit scores because the data is quite rich, quite recent. So all the RFM modeling makes sense. That's one. Second thing is, I think Shalini ma'am also spoke about MSME. One of the problem for, especially when MSME, I'm talking about the small MSME where the loan ticket size is probably 100,000 to 300,000, but the data one has to process is quite huge because it's turnover to income ratio. I'm like, what exactly is the actual turnover? Which was like, you can't, skim through those bank statements, but thanks to account aggregator, we can do it in a jiffy. It doesn't matter whether you have 4 accounts or 3 accounts or 1 account. So what I'm saying, that infrastructure which is being created, I think, a lot of business model will emerge to drive access to credit. Last thing, I think all of us lenders love salary segments. And for the simple reason, the incomes are quite predictable. It's very easy to decipher the income from the bank accounts. But the reality is that the job markets in India is evolving a lot, especially when you get into semi-urban areas or even within urban areas, so many jobs are getting created where people don't get paid on a monthly basis or they have different cash flows. A lot of those segments will emerge once we start using. I just wanted to bring the business dimension to the same infrastructure we spoke about. Yeah.
Thanks, Anurag. My next question is to Sekhar in terms of, as we say that, there is expandable data access which has been there. There are a lot of technological transformation that you need to do to consume this data and then, serve the consumers. Agreed. So how do you see yourself from a conventional bank to get into a, digital bank?
Conventional bank, the infrastructure piece is a given. Now, banks have to kind of lay the rails on the infrastructure that's already available. But while speaking of dimension, while you're building on the analytics piece or the use cases, there are 4 or 5 things that we need to keep in mind. One is reach. Second is the commercialization aspects, and third is the elimination of friction. And while we are working on this, reach, usually people get carried away. Do we want to kind of address financial inclusion everywhere? We have narrowly focused down to, say, the MSME and agri space. This is a space that we understand. So most of the solutions that we are building in is on this space. We're building our analytics solution. We're building the rails also for the MSME and agri space. Also, the second part is commercialization. Is there a commercial model available? Again, this space, primarily due to opportunity to sell multiple products across the life cycle of the customer, commercialization is relatively simpler. So that's the other piece. Third, we clearly say that banks have to get used to this entire banking as a service space, BaaS space. No longer you can do it all on your own. So we clearly have kind of constructing our interaction layer with fintechs, keeping this in mind. We are creating standardized API protocols, making it simpler, also providing them space to collaborate with us, all those things. So 3 or 4 key points, that is of focusing on areas that we understand well, going the collaboration route, and third, having a viable commercial model.
Thanks, Sekhar. Now, we spoke about the MSME in terms of, but from an MSME, there are a lot of people who would be individual business owners. I think that's the segment which, Krishnan, you would be catering more, who might take loan for their operating costs and all those things, sub 30 lakhs, 20 lakhs, 10 lakhs, 5 lakhs. And you also have individuals who take 5,000, 10,000, 15,000, 20,000. So how do you correlate both of these segments in?
There is no correlation per se, but I think what it comes down to is just building on what he said on data analytics. See, once you have access to the fund flows in the customer's account, then it's a matter of analytics and building intelligence on top of it to really understand the perspective on his income repayment capacity. Now, for a small shop owner, what you would normally see, who's a large segment that we are catering to, you will see a lot of these transactions, both debit and credit, happening literally on a daily basis. The credit is, of course, happening because there are purchases that are happening on the shop front. Debit typically happens because he transfers that fund to his separate account, which he's maintaining. So there's this constant flow pattern. How do I make sense of it? For a separate segment, which is not the typical salaried gig worker, an incentive-led person, you will see bouts of credits happening across the month, right? There'll be a spike. Fundamentally, the solution is very similar to both of them, which is how do I make sense on whether A is earning and what is his net earning, whether he has any obligation, and therefore what is the limit I can underwrite. With the new data that I'm getting, I'm able to get a fair degree of precision. I think what account aggregator has also helped us to, because it goes back historically, I'm able to predict the consistency of the income. See, when we cater to a segment, and I'm just going back a few years back, we used to do the monthly product. One of the reasons we used to do a monthly product is for us, predicting the income, but predicting the stability of the income was equally important. And one of the ways we used to predict the stability of the income is for the customer to cycle with us for a few cycles, and that's the way we know that, okay, there's not just income, but there's a steady income. But now, being able to go back into its history, I have that confidence. Suddenly I can underwrite for 6 months, suddenly I can underwrite for 12 months. It makes sense for that customer. And then lastly, I'm also using analytics. I'm able to differentiate a Kirana store guy from a machine parts because the inventory cycle makes a difference. I can do the personalization of one. Does he need a 1 month working capital or a 3 month working capital? These are all things that I'm able to innovate on my product. Therefore, we have multiple products, but we are able to do that only because there is something about the customer data that I'm able to decipher and make sense of in a very digital format.
Thanks, Krishnan, for that. One more thing which I wanted to talk about is basically we've got nearly about credit active 220, 240 million users today, with nearly about digital consumers who are on smartphone at 600, 650 million. So still there is a scope of 300 to 350 million of invisible credit for the consumers. Now this might be consumers who go for a credit card. This might be consumers who go for a personal loan, BNPL. So Anurag, my question is to you. How do you see this population coming into?
Oh, so I think the big credit has to go to the merchant community because they are making the commerce digital. Because ultimately the credit has to be use case driven. So we are very excited about it that we have seen in last 4 years, and while by the way in last 4 years, couple of years for COVID, the credit card market has gone up from 40 million cards to 90 million cards. And with UPI coming in place, it definitely will go to 250 million cards in next 3 to 4 years. That's bound to happen. And the other thing is that the moment, as the way the GDP is expanding, the GDP per capita is also lifting both sides. It's also lifting the income capacity of a customer, at the same time the consumption capacity of a customer. Both the things are extremely important ingredients to building a consumption credit market, which basically PLN cards cater to. So we are extremely excited about it. But I want to just bring one thing to that. So while the demand curve looks quite good, and thankfully the DPI infrastructure, all the hard work being done by RBI, NPCI is helping us to bring down the cost of operations. We have to remember one dimension that as an ecosystem, we have to invest in building customer education about building a credible communities of customers. How do they understand credit? Because this is very new. Okay, typically 15 years back, you will see one loan or two loan, one credit card. Many times there will not be a credit card in the credit report. That's not the case. We used to typically seeing personal loan being taken at the age of 28, 29, 15 years back. Today people are borrowing at 22, 23 age. People are starting up early. The financial education, especially around credit, is extremely important to build because ultimately if the customer goes bad, it's bad for both of us. The lenders, of course, loses money. The customer also loses the ability to borrow again for, let's say, a bigger need later on. So we need to make sure that while all the demand curve is intact, lots of infrastructure is being created, this aspect also needs to be built. And the onus is on us to build that.
Just another quick thought. So we had the government and other statutory agencies kind of focusing on the public infrastructure. And it was largely left to the banks and the fintechs to kind of innovate on the product space. But somehow we focused a lot on technology, but product innovation has not happened. Most of the gig workers or even in the markets that we operate in, they have, say, for example, weekly cycles of earnings. But most of our products are designed for equated monthly installments. So there's, and even our technology, Infosys or somebody like that, pardon me for taking names, but they say my core banking is not designed for a weekly cycle. And so there you have already government entering into the product space also. There's this scheme called PM Swanidhi, where it's a product introduced by the government and banks are distributing it. And they said you take 10,000, you repay it, then it goes to 20, then it goes up to 50, etc. So it's something that we have to be kind of careful and we have to kind of start innovating in the product space, or else you will soon be flooded. And I think so even NPCI has entered the product definition space in some ways. So we have to guard this kind of and say keep the product innovation space to us. And there's a lot of opportunity there.
Absolutely. And in fact, pardon me, but I feel that the government is the new fintech.
Government is improving the UX for the industry.
If you look at, I think that's a fair point, because if you look at what RBI Hitch is doing, RBI Innovation Hub, I think they're the best fintech right now in the country, with due apologies to all the fintechs in the team. But frictionless credit and the whole API infrastructure that Rajesh Bansal and team have developed recently, and banks like us have started plugging into that, it's kind of democratizing the access to credit, in a very big way. And clearly, the intent of the RBI as well as the government is to make it easier for people to get credit. So all of these are steps being taken in that direction, and huge support from the regulator in that sense. And particularly have to call out RBI Hedge for the work they're doing in this space. Yeah.
Absolutely. And I think we've been praised across the globe on this. So I think we are time out. I'll just open it for the audience to ask a few questions so that.
Or we can be happy that we're running a post-lunch session, so.
Good afternoon, everyone. My name is Richa, and I'm founder of Harmony Inc. We work in the space of social impact, and we've been conducting digital financial literacy session for SHG women and really micro entrepreneurs. And you did mention about the fact that it's very difficult to kind of so they actually run businesses and they want credit access, but they don't have that kind of infrastructure. Very many actually are not using smartphones. How do you see as financial institution, and this to anybody from the panel, to give them that access to credit when they are not using right now digital transactions and all? So how do you see that happening?
So I think in those instances, very clearly, Richa, it is not a self-service model that can work. It's an assisted model that can work. It can still remain digital. I don't think we can take away the fact that the process can remain digital, but the self-service piece of it will take a little longer, in my view, at least another few years away. And that's where the assisted model comes into place. The bank, we do some work with a lot of business correspondents, etc. But the example I'll give you again is something from RBI Hedge, where digital Kisan credit in states has been launched. For example, Union Bank has launched it in Madhya Pradesh with RBI Hedge, the Madhya Pradesh government and Union Bank together. Federal Bank's done the similar thing with Tamil Nadu government, where the digital agri-credit is completely digitized using APIs, including APIs from the Tamil Nadu government. So you get the public data infrastructure of Aadhaar and all that stuff, and then you do the APIs from the Tamil Nadu government, and it's completely digitized. Now, that's not a self-service model. We don't expect the merchant to go and do it, maybe 2 years later, 3 years later. But it's an assisted model where one of our people goes to the merchant with a tab, sits with the tab and the merchant, goes through that process with the farmer, completely digital in nature. He gets the money in 5 minutes flat into his account, and it's secured through eNACH and other. So that's the model that will have to be adopted for some of these segments, in my view, Richa, because if you expect them to be self-service, I think we're expecting a little too much, in my view. But assisted can definitely work.
I'll just add, since there are already pre-existing lot of schemes available for this, depending on the segment they are. A small landowner, there's some scheme up to 3 lakhs of loan with subsidies. You're a street vendor, there's something for them. Most of the time, it's awareness about these schemes.
Yeah.
So probably you can spend some time with the bank and figuring out what it is. There are now fintechs working with small-time traders where there is no financial history required. They just work with kacha-paka bills. They aggregate the small notes, and based on that, they do an underwriting. So there's a lot of activity already happening. So if you spend time with, and then take it back to the set of people that you're working with, you may find some solutions already in place.
Sure, thank
I'll
you so
just
much.
add a point to that. It's not just about the end consumer having the most advanced digital product or a phone in their hands. If you look at communities like the CSC VLEs, the village level entrepreneurs, they take digitization to the last mile. So even if that individual lady doesn't have a smartphone, she has a VLE right next to her in the form of a BC, as Shalini ma'am mentioned, or in any other shape or form where banking services, whether credit or savings or payments or transactions, can be brought to them. So there's ways and means of taking that last mile and making it digital, even though the individual may or may not have the device in their own physical possession.
So the tech and touch model will work for some time.
It does.
at
In
least.
fact, in Axis Bank, through our Bharat Banking initiative, we've seen that the CSC VLEs are extremely effective in taking all manner of financial products, not just credit. Credit is, of course, the leading edge, but all manner of financial products to people whom otherwise we would not have thought would be a part of the digital revolution, so to speak.
Great, thank you so much. Thank you.
One of the things I just wanted to add is, as much as we talk about the digital public infrastructure leading to product innovation, there's a lot that can be done on distribution innovation also. And this basically means it's no longer the classical branch, right? How can every individual be an outpost for distribution and awareness of financial? So one of the products that we have in the market is credit QR. It's not to be confused with credit on UPI, but essentially just putting stickers in few places, merchants, where with information, with the merchant being trained to explain what that product is about. And the QR just being a conduit to saying, how do I connect? Innovations like these, and if available around your self-help groups, can provide access, but ultimately it will have to be an assisted model, given the digital footprint is not there, they are not smartphone users, etc. Yeah.
Thank you, everyone. The last one.
Yeah, thanks everyone for the great insights. My name is Pushkar. I'm a solution architect at Google Cloud. So you folks extensively talked about analytics and bit of AI as well. Just I want to understand your thoughts on Gen AI perspective. How are you looking at from generative AI and how it can transform this lending business?
So credit underwriting has to be explainable because we can't use AI to discriminate against the customers. But analytics overall basis has been actively used in this credit scoring area, like Arjun said, especially after the emergence of bureaus in late 2010-11. The data is quite stable and it's also regulated data. It's coming from regulated sources. Hence, the analytics has been quite rich. With the account aggregator coming in, we will have a much more data. What I want to tell you is that most of the underwriting in India still works on structured data. We have not yet used unstructured data for the simple reason we have richness of structured data in India. Because as we were debating that, the UX has been done by the government itself. So much of structured data is available that we actually can, if we can utilize it, we itself can be good enough. So on a short-term basis, we don't see much use cases on the Gen AI side. Yeah, of course, there will be techniques which can improve the prediction power within the modeling. For example, missing data points and all that, you can actually look at that. If you want to understand the context of a customer better, those areas. But pure underwriting, I don't think it'll be a short-term solution. Anything.
Yeah, actually, I agree with you, Anurag, and I'll build on something which you touched upon. extension of credit is not just about assessing the credit worthiness. That's a big part of it, no doubt. But it's also about the servicing cost. And that is a role, that is an area where Gen AI can play a role to take a lot of the, the human intervention, the costs, the error rates out of that part of the equation. So once you've extended a credit, take a credit card, for example, there is no reason why Gen AI cannot provide a very credible and perhaps even a better alternative to a call center or even to an app. So on underwriting, we'll have to wait how it evolves. But on servicing, I think that's where a big part of the opportunity lies. And that actually makes, when you bring the servicing cost down, your credit products become more viable per se. Not just because of credit cost, but because of other operational costs which have become more efficient. And that expands your ability to extend credit to larger parts of society. So it's got a role to play, but it's such a rapidly evolving technology that if I tell you a use case today, next week it could be outdated, and 1 year later it will be history.
Actually, a quick rejoinder to that is most of the generative AI stuff is on the interaction layer, the call center, chatbots, and so on. For underwriting, a very simple acknowledgement is most banks, at least in our kind of life stage, do not have the capability to build solutions. So if you have the capability, we can provide the platform, happy to partner. Yeah.
Thanks. I think we'll have to wrap this up. Thanks to all the panelists.
Yes.
But I see that many banks have been resistant and much has to be discussed and the roadmap is still open. So,
Yeah.
So my name is Nilesh and my question is
I got
to
your question on
about
ONDC, right?
Yeah.
Like any public infrastructure, it takes time to develop. It takes time to get the ecosystem ready for it. So from a bank perspective, there are two roles that a bank can play. One is allowing our customers to be able to buy on the ONDC platform via our kind of internet banking, mobile banking solutions. That's the buyer side of it. And the other is the seller side of it, where you can give our SME clients, for example, a white labeled sellers app where they can go and enlist their products and launch. Both of these are work in progress. In fact, some banks have already gone live on the sellers app. I think you guys have, right? Axis has. We are very close to going live on the sellers app. On the buyer side, there are some discussions underway with RBI to kind of get the framework thing. It just coincidentally, yesterday I spent some time with ONDC, so it's fresh in my mind. There are some items that we're still working with RBI. But I think these are things that we will overcome because the intent and the requirement is very clear. How do you get more and more, merchant comp enabled? So that's really the intent, and I think these issues will get sorted out in the coming months. Yeah?
Actually, another in the lighter way, in UPI also had this sleepy phase. Yeah. Then the big daddies came in, and then so ONDC, so you have some big names entering that space, and you will soon see more action there.
Thank you.
Thank you so much, everyone, and for keeping that as engaging as you all.